Warning. This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. For anyone that's new here, what we like to do is come back once a week on a Saturday and perform what I call a deep dive. Now, all this really is I outline my base case hypothesis that I've had for close to 2 years now, I think, pretty much the entire time I've had this channel, and I like to check in on it once a week. Once we've seen the weekly closes, once we've got some new data for the macro side of things, I like to come back and check that everything is still operating within my expectations, within my hypothesis, within my framework. Because if it is, then I can have absolute confidence that things are going according to plan. I can continue to posture and position in the markets according to those expectations, which are yet to be invalidated. And of course, conversely, if any invalidations occur, if any of the macro data starts to move against my expectations, then I want to know in the first instance so that I can adjust, so that I can continue to stay on the right side of the trade, because ultimately I don't care about being right or wrong. What I care about is staying on the right side of the market. Now, just before we get into today's deep dive, I think it's important to point out that this one's going to be slightly different, because for all of the ones leading up to this, I have been saying we should get to around the time of the Olympics. We should get to around July, August. And then once we get to July, August, we should be looking for a number of things to start to unfold. We should be starting to see tops come in the not too distant future. We should start to be able to see recession triggers flashing. We should start to be able to see rate cuts. And we are finally here. Okay, we're finally here. So for me, I was thinking about this the last couple of days. This is really a make or break time for this hypothesis. Now, it's been through a few make or break moments in its history. There was a few times when it looked like it was about to be invalidated, and then right at the last minute, it managed to correct and continue moving in the direction that I expected. And we happen to be right around an inflection point for this hypothesis. If this is going to continue to play out, then we should be about to see a recession in the coming months. We should also be about to see rate cuts in the coming months. And we should also be about to see the tops come in for the stock market and for Bitcoin. So this is probably one of the most critical weekend deep dives I've ever done, because like I said, this has been the base case for about 2 years. Okay, ever since the lows, I was making these calls. I was saying we're going to run the all-time highs. I was saying we're going to put in blow off tops. I was saying we're going to make an all-time high for Bitcoin before the halving. I was saying that Bitcoin's top was going to come before November of this year. And critically, I was saying that around this time, around July and August, we should start to see a whole heap of civil unrest. We should start to see the Fed being forced to cut rates, likely because it's too late, likely because it hasn't realized inflation is actually not as sticky as people would think it is. I was also talking about seeing the proliferation of this soft landing narrative, people thinking right as we got around this July-August timeframe that higher for longer in terms of the markets rallying would be the base case. And that is exactly what I'm seeing so far. I am, even though that this is something I've been talking about for over 800 videos now, over the last couple of years, I am frankly a little bit shocked at just how precise this has ended up being. And so again, I'm here to tell you this one's slightly different, because if this thing is going to continue to be right, then we are very, very close to a top. I don't think we are in terms of price. I think we go a lot higher, but I think that happens in just a matter of weeks, perhaps even a few months at the most. And then I really think it is time to either see this come to fulfillment, to either see this market top come in and us enter a recession and see the economy completely break and a gross deleveraging occur, or I'm going to have to hold my hands up and say, this is completely wrong now, okay? It's been right for a while, but it is now wrong. So this is a very, very critical moment for this hypothesis. It's a very critical moment for my assessment. And like I said, it's been right for a long time. If it can just continue to be right for a few more weeks, then unfortunately some tough times are coming. And I'm noticing that these tough times that I'm seeing start to appear, these cracks in the system, have formed as expected, against a backdrop of people telling me, you are crazy, we're going up till next year at least. Okay, so strap in. Once again, in case you're new, we're going to outline the hypothesis, make sure everyone's caught up, and then we're going to point at a few things that they either need to happen, like I said, to complete this idea, or if they don't occur, then something else is going on. I've got my timing wrong. We're probably going to run for longer. And as always, it's not about being right or wrong. It's simply about me staying on the right side. I do not want to exit the market or flip short if this bull market is going to run into next year. If it's going to run into next year, I just want to stay long and catch as much of the trend as I possibly can. So with all that said, this was the base case idea for the stock market, that everyone at the lows was too bearish and we were going to run to new all-time highs before ultimately having a rollover and a big recession, like I said, and a deleveraging in the economy a real tough time for a while. And during this period of downside, if it was to occur, we would see asset price deflation. That is CPI that is negative year over year and month over month. I was also calling for this to be the end of a multi-decade long cycle. So we have a blow off top at the hard right edge occurring within the context of a multi-decade blow off top. For Bitcoin, the idea was pretty simple, that again, this cycle would actually be different. And those are the kind of words that you should never really utter. A lot of people really have a problem with that. But in line with expectations, we did indeed print an all-time high before the halving, and I still stand with my base case idea for now at least, that the top for this market in Bitcoin is going to form before November of this year, qualifying it as left translated. When we fast forward to today, the stock market is looking eerily like we are moments away from seeing that near vertical third and final blow off top angle come in, and if that is the case, then I'm expecting this thing to violate spectacularly to the downside. I'm expecting us to enter this recession, this big bear market, and for the economy to undergo a bust. You will notice, do they cut rates here? This white text has been here the entire time. That has been the expectation, and we are just so happen to be right around the corner from rate cuts. Whether that is a surprise cut at Wednesday's meeting or whether we don't see one until perhaps as late as September, cuts are coming. And as you're going to see by the data set I present a bit later on in today's episode, the conditions favor a top coming in within about 2 months of the onset of that cutting cycle. For Bitcoin, the fractal that you saw earlier on was taken from back here. And what's interesting about this Bitcoin fractal is each component has been there, but each component has taken slightly longer to play out. So you can see this area here fits quite nicely, but to make the next Bart Simpson type pattern fit, we have to stretch this fractal out a little bit, and then this section fits quite nicely, okay? You can see the Bart Simpson fits. This kind of fits for a while, but then by the time we get to this choppy section on the fractal, again, we need to stretch this thing out a little bit to make this middle section fit. Then you can see the next leg up fits quite nicely, and again, we seem to get stretched out here at the hard right edge. So this correction here in this fractal has of course been stretched out significantly longer than before, but I now think we have completed enough time. I now think enough time has elapsed to see us move higher into this third and final angle for Bitcoin, this third and final blow off top angle. Fractals were never meant for trading. It was just an expectation, I should say that, and ignore the prices, okay, because I actually think we go a lot higher than what this fractal suggests. But wholly speaking, we did indeed hit an all-time high before the halving, and so long as we top before November of this year, qualifying it as left translated, then I will be able to tick this one off and say it behaved more or less as expected. There is also an Elliott wave count I've got here from Tony the Bull that supports what we are about to see as that third and final angle come in for Bitcoin. This will be the fifth wave in the Elliott system. For anyone that doesn't know, I like to use 3 angles of increasing steepness of attack. 1, 2, and then soon we should be looking for that third and final near vertical blow off top angle to come in. That is where I'm looking to exit the market, and the same strategy will be applied to the S&P 500, meaning we have our first angle somewhere approximately in here, we have our second angle somewhere approximately in here, and then again we will be looking for a third and final near vertical angle to come in if indeed we are going to see a blow off top, and on violating that third angle to the downside, you will see me exit the market and flip short for the stock market as well. So overall, things are going roughly speaking according to plan. I'm going to get through the rest of this presentation, and then we're going to come back and I'm going to point out exactly what we need to see for this to continue to be in play. Because as I said at the start, if things don't start to go essentially immediately vertical, okay, then something is off with my timing, and perhaps the people that are saying we've got more legs left in this ball, we're going to run into Q1 or even later than Q1 of next year, perhaps they're correct, and I need to adjust my posture and my stance so that I can continue to ride this trend into 2025. A lot of this idea of mine was predicated on the idea that anything you do to the M2 rate of change shows up in the CPI with around an 18-month lag, okay? Now, we did really well at calling all of this and following this, okay? And that presented in the spike in CPI followed by the downside and that wobble, and I have been making the case that this third and final leg down in M2 is yet to manifest in the CPI. So whilst the market seems to think inflation is sticky, I have been suggesting that we have yet to see the true downside effect. The Fed is already late to cut, and inflation is indeed going to start to drop like a stone until eventually we slip into a short period of asset price deflation. This is further evidenced by this TMC global credit impulse that leads CPI by about 18 months, and you can see this has been telling us for some time to expect continuation of disinflation before ultimately a short period of asset price deflation, as you can see here. And I think the market continuously is looking right in front of them instead of looking forward in time. I keep seeing things like this. Well, the PCE inflation data that came out this week was above expectations, okay? It was 2.6% above the expectation of 2.5. And so people are asking the question, can the Fed really cut rates in September? But just as you get a market move up and have pullbacks and short-term wobbles, okay, before resuming the primary trend, we get the same effect of short-term wobbles and short-term counter-trend moves in macro data sets. And again, I say everyone is looking immediately in front of them instead of looking forward. And if they were looking forward, they would likely understand that what is coming is continuation of disinflation before ultimately a short period of asset price deflation. The facts are the facts, the data is the data, and the trend is the trend, okay? Core PCE went from 3.7 to 2.9, yet people are going to be screaming about how inflation is rising and hot. These people are not living in reality. There is no reason to take them seriously. And when we pull up the June PCE inflation data, okay, look at the hard right edge of this chart. What do you see? Does this look to you like a period of sticky inflation? Because to me, this looks like we've had some wobbles and we are about to continue to move to the downside, again, supported by the leading indicators such as the M2 rate of change and the TMC global credit impulse. This is further supported by the Atlanta Fed flexible price core CPI, which is currently at negative 1.9% year over year, which is amongst the lowest level ever, and it's minus 2.8 percentage points below the 2010s average. Moreover, it's at similar levels as it was back in December of 2008 when CPI was just plus 0.1% year over year. Okay, we are already seeing deflation, but the way they calculate the general CPI basket includes a lot of shelter. The shelter is the biggest lagging component. Again, I am here to suggest that we are going to continue to see CPI come off very, very rapidly and that the Fed is already too late to start cutting. In addition to the CPI data, we've been carefully monitoring the unemployment data. Okay, this is initial jobless claims here, looking slowly but surely like it is thinking about spiking to the upside. And of course, anytime it does that, that is synonymous with recessions that you can see shaded in the green areas. Furthermore, pertaining to the unemployment level, you can see here, again, at the hard right edge, we are curling up. Okay, we are starting to curl up. We are starting to look like this thing is about to explode. And it happens gradually at first and then very, very suddenly. And again, we only have to look left to see what happened in all the prior instances. And of course, they are synonymous with recessions shaded green on this chart. So of course, unless we suddenly see significant periods of sticky or hot inflation prints, and unless somehow the unemployment level completely does a 180 here and starts to do something like this, same with the initial jobless claims, unless the initial jobless claims start to morph into one of these kind of looks, okay, then to me, these are more points in our favor that a recession is much closer than people are willing to accept. Furthermore, we got the real-time SAM recession rule indicator. Okay, again, hard right edge, it's above the zero line and creeping higher. This is exactly what we see before all of these prior instances of recessionary periods. It does not, of course, mean that we could not roll over, okay? But if it doesn't, then again, it is likely to initially start gradually and then very, very quickly morph into a sudden spike look, just like we've seen in the prior instances. And again, all of these prior instances were synonymous with recessions. Meanwhile, the Fed is scared of acting prematurely. The Fed does not want to be seen in a position where it says we were too late to hike rates and inflation got out of control, only for them to be seen to be cutting prematurely and at risk inflation running wild again. So the Fed is dragging its heels here. The Fed is deliberately taking its time and being late to react. And again, it is looking directly in front of its nose as opposed to looking forward into the future. The Fed is currently taking the stance that it would only support earlier rate cuts if the unemployment rate increase is driven by layoffs. But the problem with that is the past recessions all start with labor force expansion, and usually only about 2 quarters into a recession do layoffs rise sharply. So you can see here, okay, it's the same deal. They are already late to react. And if they don't start to cut pretty pronto, then we are likely going to see unemployment spike significantly. Again, fits with everything I've shown you so far. Furthermore, the US 2-year bond yield has been a very, very good tell for when the Fed is about to start the onset of a cutting cycle. In green, we got the 2-year yield. You can see in all prior instances, every single time the 2-year yield led lower, we saw the onset of a Fed cutting cycle shortly thereafter. It was the same in every instance. 2-year yield in green moves lower, the onset of a Fed cutting cycle in orange shortly thereafter. You can see in every single one of these cases. And today, okay, this is a chart posted back in April of this year, but today we have already morphed into a look like this, okay? We are already in this neighborhood, and I can show you that here with the candlestick chart, okay? We have already broken down, we are already close to retesting these lows. So again, we are already in this neighborhood. This is the bond market in aggregate, pricing in rate cuts coming in the not too distant future. Whether they come this month on Wednesday or whether they come in September, or perhaps we could even see an emergency cut sometime between the two meetings. The bond market in aggregate has been, historically speaking, very good at pricing in the onset of a cutting cycle, and it is doing the exact same thing today. Again, telling us that the bond market thinks the Fed is already too late to cut. It is already starting to price in the rate cuts. It knows the Fed is going to have its hand forced very, very soon. And so why then, Camel, are we so obsessed with rate cuts? Can't rate cuts be bullish? And the answer is it depends entirely on the context. Rate cuts into normalization with a soft landing can indeed be bullish, but that is not the setup we have at the moment. At the moment, we have unemployment spiking, we have the consumer in a very, very bad way. We have inflation already slipping into deflation with many commodities such as the grains, wheats, corns, etc. already showing deflationary looks. We also have nat gas selling off heavy, and oil, in my speculation, is about to follow suit and sell off as well. And therefore, this is not likely to be a soft landing. This is much more likely to be a hard landing. At the same time, and we're going to talk a little bit more about this in a minute, we are seeing consensus in the market that a soft landing or no landing is the base case. Close to 90% of the analysts on Wall Street see their base case as a soft landing or no landing, with only about 10% of them calling for a hard landing. And what is so spooky about this is exactly what I was talking about all the way back at the lows. I was saying by the time we get to the top, nobody is going to believe that the top is here. Everyone is going to be very, very sure of themselves that there are many months of bull market left. And I am here to suggest that, again, based on everything I've shown you, we're about to see cuts. That's what the bond market believes. It makes sense from an unemployment and an inflation perspective. And based on the prior 3 cuts, as you can see, which were not cuts into normalization with a soft landing, it is very, very likely that when we see this onset of a cutting cycle, the stock market is going to top within a couple of months of the onset of that cutting cycle. We saw the same thing here, okay? Fed cuts rates, market tops. Fed cuts rates, market tops with recession, again, with recession. And again, we saw this in the dot-com bubble. The Fed cuts rates, okay, the market tops soon thereafter, and of course we enter a big recession. I believe the setup today is very, very similar. I believe that whilst I do think we've got a third and final angle and one final hurrah, one final squeeze to the upside, I also think this Fed cutting cycle is going to come very, very soon, no later than September. And when it does, we are likely going to see major tops come in for the stock market. And remember, all of this against a backdrop of spiking unemployment, inflation, for which the Fed is already too late to react to, a whole heap of people out there, traders, investors, and Wall Street analysts that think this whole idea is premature. They think this idea is crazy because they see a bull market that has legs well into at least Q1 of next year, if not late 2025. Another point in the favor of a recession is the yield curve in blue, okay? Now, a lot of people get this wrong because a lot of people think the moment the yield curve inverts, that tells us a recession is coming. When the subtle nuance is, it is the cross back above the zero line, the reversion of the yield curve, and an acceleration to the upside that causes the recession. Now, when we zoom in again, okay, look how close we are to that zero line. We are incredibly close to the zero line for the yield curve to revert. And historically speaking, it is when we cross back above zero and accelerate to the upside that we get the onset of a recession. To see this more clearly, okay, here's the prior times we crossed back above the zero line and accelerated, crossed back above the zero line and accelerated, crossed back above the zero line and accelerated, each one denoting a recession shaded in grey. It was a similar deal here, although the yield curve technically didn't invert here. It just bounced off the zero line. And again, at the hard right edge, we are slowly but surely morphing into one of these looks. If indeed this is to occur, again, it tells us a recession is indeed here. So if you want to avoid a recession, we really need to see this thing start to morph into one of these looks. Not something I believe is likely personally. And again, fitting in with this theme, you know, it's very easy to look at where we are now and say this bull market must have legs. Okay, Bitcoin always tops at the end of its 4-year cycle and then enters a 12-month bear market. It's easy to look at this kind of liquidity cycle data and say, well, global liquidity is moving up. Okay, so there's plenty of legs left in this bull. And people like this are very sure of themselves, right? The bearish mind can't comprehend this, okay? Now, whilst I'm not discounting that liquidity can continue to rise, what I am not really convinced of is that the stock market is going to continue to rise with it, okay? Back here, the bottom in the liquidity cycle was the peak in housing right before the GFC. Notice how liquidity was rising the entire way through, okay? And we still entered the great financial crisis. I believe a similar setup is going to occur today. I'm pretty sure we're going to see liquidity continue to increase. But I think similarly to back in 2008, we are likely not too far from a recession. And again, fitting in with this theme, we're seeing history rhyme and repeat over and over again, okay? This article right here in CNN was posted on Thursday, July 25th of 2024. And it says the US economy is about to pull off something historic, okay? When we scroll down, America's economy is about to stick what's called a soft landing, which is when the inflation returns to the Fed's target without a recession. However, note the date on this piece right here, March 28, 2007, right before the GFC, when Bernanke was out here saying no recession is on the horizon. Again, I say history doesn't repeat, but it does often rhyme. And so again, I am here to say, okay, The average market participant seems to believe this bull market has legs to run at least into Q1 of next year, if not late 2025. Assuming we can just find a cycle low in the next few sessions, if it's not already in, and then set a near vertical third and final blow off top angle, followed by rate cuts showing up within about 2 months of that top for the stock market and a true trendline breakdown, then all I will be able to do is sit back and say everything has gone exactly according to plan. Everything is trading exactly as expected. For Bitcoin, assuming this was the low and we are now about to morph into a near vertical parabolic advance, okay, assuming what comes next is that we've had our first angle here, our second angle in here. Again, the only missing component is for Bitcoin to morph into a third and final blow off top angle, something akin to this. And again, I am here to say everything is going according to plan. But as I said at the start of this video, okay, we have reached a real inflection point for this hypothesis. Because if we do not start to go vertical here, if we do not complete this parabolic blow off top in both Bitcoin and the stock market, okay, anything other than essentially straight up for the next few weeks, and something else is going on. Whether that something else is a corrective phase, a basing, whether that is a more significant period of downside, or whether this is more of a gradual grind, okay, and a bull market that can indeed continue to run until Q1 of next year, or perhaps even late 2025, anything other than straight up near vertical blow off top angle here is me having to hold my hands up and say something is wrong, my timing must be off. But of course the inverse is true, right? If indeed we're about to do what I think we're going to do, if indeed we're about to go near vertical for the stock market, if Bitcoin is about to break its all-time high and enter its third and final angle with that fifth wave in the Elliott system, okay, then all I can do is hold my hands up and say everything is still going according to plan. So it is an absolutely wild time to be alive. To be clear, I don't really care about being right or wrong. If this is what's in play, okay, then my focus is pretty simple. Can I sell the third and final angle breakdown? Can I exit as close to the top as possible? And can I stay out of the way and figure out how to deal with the next portion of this downside? And if I'm wrong, okay, if I'm wrong about this, then again, I don't care about being right or wrong. What I care about is if something more like this is coming for Bitcoin, okay, followed by a right translated cycle that tops at the end of 2025, then I certainly don't want to be exiting the market here or flipping short. I instead want to be focusing my attention on being able to ride this trend to the end of 2025, and then I will be looking to get out here. But as far as I can tell, this is the most critical weekend deep dive ever, okay? If we really are going to continue to be right, if we really are going to see this fifth and final wave, the third angle coming for Bitcoin, if we really are about to see the blow off top in the stock market, if we really are about to see the onset of a cutting cycle, which of course, as I've shown you, the bond market believes, if we really are about to see unemployment continue to get more and more aggressively out of control, if we're going to continue to see inflation slip into disinflation before ultimately asset price deflation, and if we really are about to slip into a recession, then it should all be about to occur within the next couple of months. So with all that said, I continue to stand with this posture until it is invalidated, and anything other than practically near vertical immediately would be this blow off top idea being invalidated, at least from a timing perspective. But based on everything I've shown you, it seems an awful lot like what's coming next is a final major upsize squeeze to complete these parabolic pushes, to complete Bitcoin's left translated cycle. Then, of course, I suggest to you that we have got some tough times ahead. Moving into the charts, we are still hunting for a cycle low. There's a good chance it's in as of Thursday's session, but it hasn't confirmed it yet with a trendline break. As soon as it does, you'll see me add a position and move stops up, and then look to capture what I believe will be that third and final squeeze to the upside. It's the exact same analysis for the NASDAQ, okay? We were talking about getting a two drives pattern. We seem to have gotten that. We will now be looking in the member section as well to get some NASDAQ exposure here and catch this final leg to the upside, which should, of course, be a near vertical parabolic blow off top. The Dow Jones looks to be thinking about setting its third and final angle long and strong there. In terms of the VIX, they did, of course, come in on VIX Crush Friday and start to crush the VIX. So I would expect this yellow squiggle to play out whilst we get that final leg to the upside, and then it will be time to long the VIX, I think. For the Russell 2K, we are still pushing the long from close to the lows, and we are still targeting 2700. Not much else to say about that. Gold, we are still waiting to see a tradable weekly cycle low. It will be really easy to identify if we can get a sweep underneath all the prior daily cycles. Something like this would be quite nice if we can get that, and then I think we can get behind a big gold and silver move, particularly in the members section. Bitcoin appears to be climbing a wall of worry, but again, as I showed you earlier, we should be expecting this third and final angle to come in, okay? It's been resting here, you can see. First angle in red, second angle in red, and now we're looking for that third and final angle to come in, perhaps something akin to this. Again, any kind of rejection here, okay, any kind of, I don't know, distribution looking thing, something like this, okay, then we're kind of invalidated because we're clearly not setting a third and final angle. We're clearly not in that fifth wave, okay? Any kind of, I don't know, failure from here, trade below that cycle low, stop me out, okay? Then that's me saying this idea is wrong. But all it will take is something like this, a break above the all-time high and a big fat squeeze. And again, I will be here to tell you everything is going according to plan. The crypto-related equities that we've been trading in the members section, those and about 10 other ones perhaps, I think about 8 other ones, they're all looking very, very good. Okay, none of those crypto-related stocks believe that that was the Bitcoin top and distribution is coming next. Meanwhile, the Dixie is looking quite heavy out of its daily and weekly cycle low, okay? So if indeed this thing can roll over, we might be able to say that this was not the 3-year cycle low. This is in play to be a 3-year cycle low before ultimately we get that big, big push as the dollar becomes a flight to safety asset, as the markets top and people flee risk assets to enter the dollar. Needless to say, if this is what's coming next, perhaps on a surprise rate cut as of Wednesday's FOMC meeting, then you better believe this will be like adding kerosene to a fire in terms of the blow off top. So what a wild time to be alive. It is crazy that I've been talking about this every single day for around 800 videos over the past 2 years. And now we are finally in that window. I've been talking about the July-August expectation, been talking about seeing rate cuts show up around here. I've been talking about the stocks and Bitcoin putting in their tops somewhere around this neighborhood. And we are finally here. So again, it's not about being right or wrong. It's about staying on the right side of the market. I hope you consider what I've said today. Again, if I'm right, then things should start to go vertical. And if I'm wrong, it doesn't really matter. It just means we get to stay long and strong for a little bit longer. Other than that, if you're a level 3 member, look out for the members only video that I'm about to put out for you guys. And for everyone else, I hope you have a fantastic weekend. I hope you're doing well in life. And until next time, take care from me. All the best. Cheers. Bye.